Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, the number one value investing podcast in the world. Hope you are having a great day. Sitting next to Jeffrey Harvey Gannon. Jeff, how's it going today?
It's going well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. I'm sipping out of my Focused Compounding mug, and rumor on the street is that we are going to make a bunch of those in the near future for people listening. So be on the lookout for that. Probably the best place to get information on that is I'm going to tweet out about it at Focused Compound. If you're listening on the YouTube side of things, make sure you hit the subscribe button. If you're listening on the podcast side of things as well, the subscribe button goes a very long way for Jeff and myself, helps hack the algorithm, both on the podcast side of things and on YouTube. And so in today's podcast, we're going to be talking about defense in depth. Okay. And thinking of different ways to sort of improve the margin of safety. Mm-hmm. We've done a lot of chatter about, the Davis double play, right, or different ways that you can make money in a stock, whether it's, price appreciation, a multiple re-rating, a dividend. And these are things that you always think through when investing in a company, different ways that you can, sort of hit your IRR, if you will. Mm-hmm. It's almost like doing a pre-mortem. Right. What could go wrong? How can we hit this return? And then, thinking backwards, or, I guess you could think about that's sort of like inverted way of thinking about it. But take me through when you're first looking at a stock. So you've come to the point of, okay, I like the business a lot. I would like to own it. Mm-hmm. Let's say it's trading at a price that you think is cheap. So 2/3 of what you think it could be worth. Okay. What are some other things that, would just be sort of the cherry on top of the value cake that would make you even more excited about investing in the business? Like the business aside, right? Mm-hmm. The business aside. Let's just talk about price.
Right. So there's two ways that this can happen. One, I'd say, is more like we could talk about like strong point defense, like having one thing that you're relying on entirely. And those can be great. And those are often things that have the best defense of all, but they're could be rarer. And you have to have a lot of confidence in that. So you can have confidence in one thing that you are sure is not going to collapse, right? So basically you could have confidence, Buffett could have confidence buying into Coca-Cola, the brand would not collapse as a thing that had a lot of value. And so you don't need other sorts of defenses that way. But the other thing that you can have is what we talked about, defense in depth, which is an idea of multiple compartments of defense that you could get value from. So the Peter Cundall book is a really good thing for reading for that kind of stuff. But some examples of things I've done in the past are like buying Japanese nets where they were selling at less than net cash, and also their operating business had made money every single year. So the combination of those two things means that there's a positive value on the business and it's a cash box. Now, if you just buy a cash box, things can go wrong in ways that you won't get your money back. And if you just buy a business at a certain PE, right, it may contract. But if you're able to buy like 5 of these different things where in each case there's a cash box and a business attached, you tend to do really, really well. That was Ben Graham's experience. That's been my experience. So that's one example. Mm-hmm. George Risk was a very similar one to that, where I bought into a stock in which I bought for a little less than net cash, and I thought the business was really good. And there, that's as an example. I went on and owned that stock for 6 or 7 years, and even in a time when the market went up a bunch, it actually did about the same, right? So even that, in terms of like when we talk about dead money or something, because you're buying at a price that's so low, you often get fairly good returns and things. So that is something that I do all the time when looking at things. An example we've used a few times now, which is an example of how that defense can come in handy, and you don't plan for it, is Virtu Motors. So accounts we manage own stock in Virtu Motors, and a lot of people would talk to me about it. I'd talk to them and whatever about UK car dealers, and I was more interested in Virtu than some of the others. And the reason why is because it basically hadn't drawn on various things of credit that it could use. So it owned about half of its land, the land portfolio, half of the dealerships. It hadn't really borrowed anywhere like other car dealers do against their used car inventory, which is a lot of inventory. And so basically you had this opportunity where you had stuff you hadn't borrowed against, as compared to a company which is borrowed against everything. Mm-hmm. And so the idea is that we're talking about is, yes, your price to earnings can be fairly low or whatever. So we bought that at a mid-single digit PE, right? and that's kind of how you can get the return. But also, if ever they leverage up, your return is going to be really good, right? That's the way of thinking of it as positive, which is usually how people think of it. They go, okay, what's my upside here?
Sure.
But the other way is to look at it at the downside, which is if anything happens, and COVID happened, there's a way for them to borrow money without diluting me, without basically borrowing it in the sense of like putting on, having to do basically things similar to bonds, and stuff like that. Instead, it was something that was all about using borrowing capacity that others had used that they hadn't used, right? Mm-hmm. So that's kind of the idea. And so you have different ways in which you can not have your value of what you invest in impaired, which is more the way I think of it. Instead of like how many different ways can I make money, it's more like what can go wrong and I can still do okay. And you know that from some things where I've talked about stocks before where I said, okay, well, if you're paying 6 times earnings or something for this stock, then it can lose a third of its earnings power from something and still be cheap. Like we talked about psychomedics or something. Mm-hmm. And that was a thing where obviously they're going to lose some earnings power. They're going to lose some free cash flow. But on the other hand, does the price already reflect that? Because you're already a lot cheaper.
And I think the hard part about that, though, is if you're already in the stock, you may not think about it like this, but I know the way that other people think. If the stock immediately drops on that news, even though it's already basically priced in by the way it's trading today, a lot of people assume that it's a lot worse than it really is, or the stock gets cheaper.
Sure.
So that can make it harder for some people. Do you also think about, for example, I think most investors, they say, okay, this stock is, trading at $30 or $30 per share. We think it's worth, 40 or 50. That price difference is my margin of safety. I think one difference that you think about it as well, and relating to the price, I know we were talking about, the solvency of the business before, their ability to borrow, leverage up, et cetera. You may think about it, okay, yes, it's trading at $30. It could be worth, $50 to $60 or $40 to $50, but it's also trading at, generates free cash flow. It's a 12% free cash flow yield or something like that, where if the stock does nothing over the next 5 to 10 years, you're going to get all that buildup in cash in hopes that, that only improves your margin of safety.
Yeah, absolutely. And so, that's a question that people have asked about stock we own, NACO. And I said, like, how much has the value of it deteriorated over the time that you've owned it and whatever, because they're presumably will lose a major customer and, it'll take a while to shut down. But the truth is not really that the value is that different. Mm-hmm. And that surprises people. But the reason why the value of the stock isn't tremendously different is because you went from a situation in which you had some debt and stuff and you had cash, and you didn't have a large amount of truly surplus cash. Okay. And then you went to a position where you actually had a lot of that versus the stock price. And so what happened is that if you build up free cash flow, like you said, over a period of a few years, then actually that can be as much as, the value that you would have gotten from a customer that way or something. So for instance, if you had $1 of earning power, and now you have $15 per share or something, and now you have $15 in cash per share. Well, those are basically the same thing. If you've, just as if you had sold the business off or something and gotten 15 times free cash flow or something, that's basically the same thing. And so, if you build up free cash flow that way, then obviously, and by the way, that's reversible that way too. That's what I always point out to people. Like if a company has a lot of cash, you have to be careful because, not to undervalue it, because of course it can just go out and buy something that has that earning power.
That's what I was going to ask.
Yeah, right? If you have $15 in cash per share, you can go out and buy, presumably, something like $1 in earning power that way. So if you don't want to bias yourself too much to being like, oh, I don't count the cash, I don't care about assets, but I care about earnings. Earnings and assets have to be translatable back and forth at some level. And so, and they will be the moment that they actually do it. When companies do pile up a lot of cash, if they then go out and buy a good business, then suddenly the stock goes up. But really, the assets are always there, the same.
Mm-hmm. One of my favorite articles that you've written before, and I actually tweeted this out last week. I did. You were talking about how to handicap a stock, and like this whole idea of what is the right multiple to pay for a stock. Mm-hmm. And in that article, you were talking about assuming that the stock when you sell is going to be at a market multiple.
Okay.
Right. what if the multiple doesn't re-rate, for example, or what if
this is the biggest complaint from people? Yeah, in my experience, you have to evaluate the business as best you can, get an honest idea of what you think the enduring business quality is, what the real inherent qualities of the business are, the industry it's in, its position in the industry, whatever, and give it the appropriate multiple for that. You have to ignore what the market is currently valuing it at. And this is my biggest complaint with something like, I like things like Value Investors Club and stuff.
Yeah.
But the thing is basically you just look around to what are they valuing other stocks like this at today. So if all bank stocks are trading at 1 times book today, you use 1 times book. And if 10 years ago they were all trading at, if 15 years ago they were all trading at 2 times book, then you would have used 2 times book. But should you have done that? And I think that some of the best ways to make, in my experience, some of the best ways to make money actually have been the most reliable, have been to correctly judge the value of a business at a time when others aren't that way. So, but does bother some people because we bought into a stock, Computer Services. It operates under the name CSI usually, but it's a over the counter stock that is really big and is in the same industry as other core processors. So people would know like Jack Henry and stuff. It's like those.
Pfizer,
Yeah, exactly. And we bought it at, you adjust for some things, there's a tax thing or whatever, but basically bought it at 15 times where I thought normal earnings would be. Okay. So a P of 15. I did that because I thought a core processor type thing should trade at more like a P of 25 or something. Now, that's not necessarily just based on what other core processors are trading at. I wouldn't do it if it was just what they're trading at. I would do it on how high quality the business is and how much I like it. It's similar in a way, though not as growthy, as OTC markets, which we've talked about more, and the economics of that. So the economics and the growth and stuff in OTC markets is a bit better. But still, you'll notice that there are businesses where I say it should be worth 25 times earnings or something, and I don't use 15.
Does that come from your judgment, though, of looking at high quality companies? Or
Yes,
is it more so like from a math perspective?
It's from a math perspective,
Okay.
but it is judging the quality of the businesses. So for a business to continue to trade at a high multiple and stuff, it should have the ability to reinvest its capital and it has to be at high rates of return. Otherwise, that shouldn't be happening. So if it doesn't have a high rate of return, then I wouldn't value it highly that way. Now, sometimes that means I'm very different value than other people would have. And maybe you could sell the company for something like that. Like I've talked about, I've looked at some software companies that don't make any money really. And some of them are trade at 5, 6, 7 times sales. Presumably, I guess you could find someone to buy them for that. I mean, that's what they trade. That was what these companies trade on the market. And I guess there are acquisitions done at those levels. So if I knew more about the software business, maybe I would know those things could be sold at those values, but I would never put those values on them. I would never put those sorts of things because they don't have any hopes of having 60 or 70% operating margins that I can see. So I wouldn't value them that way,
So let's break this down. Let's give a blueprint. So a company that is worth 25 times earnings, I know this is sort of pie in the sky type of stuff. What are the qualities? Like, what do the operating margins look like? We've talked about before how you don't need, 15 to 20% top line growth. I mean, what does it look like?
6% or more a year while using no additional capital.
Okay.
That would make it worth 25 times.
So 6% in free cash flow, earnings, all of it. I mean, we've talked about that all the time.
Free cash flow over time, but in any 1 year or any 3 years, it doesn't matter. I mean, if they're growing free cash flow by 10% a year, but they're growing sales by 2% a year, then you've got to really evaluate it because something's wrong.
Sure.
Something's off. But if everything, let's have a hypothetical in which everything, sales, free cash flow and stuff are all growing together at 6% or more a year, then yes. If it grows at 6% or more a year while also being able to pay you 4% in free cash flow, then that's what it's worth. It's worth 25 times earnings. And that math is pretty simple that way. It's pretty simple for companies that use no additional assets. That's the warning I want to give for people. There's a reason I think people know that I use like Omnicom as an example or OTC markets. It's because of mathematically they're very easy examples. I can also do very easy examples with insurance companies or banks, which have constant, if they choose to, leverage ratios, and also the business is all done in cash. It's much harder to come up with, should a asset heavy business, what's the right multiple for a railroad? That's actually really hard to do because it's kind of complicated. They are replacing things in modern dollars when it's on the books of the old dollars. They do have to put in a lot of money to be able to grow that way. Those are trickier. Or we talked about Stella Jones, companies like that. they can be good and they can earn money, but as you take assets into it, it's more complicated. Whereas if you said value Facebook, that's actually relatively easy to do if you could tell me what the growth rate will be for a long time, because it doesn't have to put in more and more assets.
Yeah, because you used to do blind market or blind stock valuations all the time through your blog.
Right.
So I was always curious how you sort of think about that. So if you see a company though that's, growing sales by 6%, returning 4% to you in some form, is it really from there, trying to understand what allows the business to do that? Is that because talk about OTCM, for example, or CSI Industries, there's a lot of qualities in that business that allow it to, sort of earn those type of returns, which makes it more comfortable for you to pay a higher, a higher valuation ratio today. Because we get a lot of people that you have said that generally speaking, as a rule of thumb, you don't want to pay more than 15 times.
That's definitely true, yeah.
Huh?
Yeah, that's definitely true. Yeah.
Yeah, 15 times, earnings and stuff like that. But there's times when you have, but there's differences in those types of companies that have allowed you. So CSI Industries, even though we paid 15.
I'm trying to think. I'm not sure that there's any time I've paid more than 15 times what I thought earnings
Okay,
were.
but what about OTCM?
Okay. So that is true that we did pay more for OTCM. That's one example. Although we did. But it's not a lot more than what I think their actual normal free cash flow is, which we could get into. But yeah, we did.
Okay.
So that's an example of one.
Okay, so what allowed you, the comfort, I guess you could say, to make those purchases? Is it the fact
that was the least comfortable.
Okay.
So that was an objectionable price to me.
Okay.
I like the business. We did it. But that is the most I'll pay for business, is what you saw with OTCM.
Okay.
So there was something about that business that allowed me to pay the most I'll basically ever pay for a business.
Okay, and then what about CSVI? So we paid roughly 15 times after tax earnings. I think the business is growing.
What they would be once the tax cut happened.
Yeah. The business is still growing 5 to 6% per year.
Right.
Has incredibly high customer retention rates, long-term contracts. There's a lot of qualities that allowed it, the ability. So that's probably what made you a lot more comfortable. And I guess you sort of had this other thing when, getting back to, sort of like the defense part of it, right? All the competitors were trading 40 to 50 times earnings.
Right. So yes. And not only that, more importantly, the 4 biggest core processors in the US, of which computer services is the 4th, are all publicly traded and have all been fantastic stocks for decades.
All been 100 baggers plus.
So they've all been terrific stocks for 50 years, or basically since they started. So that is a hint, and I've said that before about industries and stuff. If they produced billionaires, if they produced fortunes, if they produced 100 baggers and stuff, then that is a hint that industry is really good. People argue about whether an industry is good or not. Well, if there's if they created fortunes over time, basically it's the best indication you have that an industry is good. Now, sometimes there's only a few winners in an industry. Is operating systems a good business? For one company, it was. For everyone else, not really. But it does create a mega fortune for someone in there, so it gives you a hint that it can be. So in terms of the defense and depth thing, I think the important parts are, one, having and I've said this many, many times, I really think that 50% of the valuation of the decision to buy a stock, maybe not the valuation, is the industry that it's in. Yeah. And the other 50% is the business itself, especially the business model itself and its position in the industry. But that is true. So, and I think that is a defense in depth concept that's hard for people to understand sometimes. As an example, let's take a cement plant or something. If it's not being run the best in the world, I'm still kind of willing to buy one if it's at a really cheap price versus its capacity and stuff, because someone in the industry can take it over and run it right. So I would be open to that. There are assets like that. And it's not just that, it's Lime things and it's whatever things. Industries where I feel that it's predictable enough that way and that someone could do that. There are other ones where it's somewhat similar. I mean, I talked about Virtue Motors before. Virtue Motors, if it was a retailer with the same economics and stuff in a more, in an industry that I felt was more, I don't know how to put it, a more difficult part of retail, a less reliable part of retail.
Clothing.
Than car dealers. I just have a feeling that car dealerships, we could get into it and stuff, but that in general, under different management and stuff, could be run well enough. So I liked Virtue and the management and all that, but I'm just saying that there's a certain value to a somewhat successful or whatever Volvo dealership in a certain location, that someone should be able to own it. And in fact, at some point, Volvo will say, someone's got to own this. And, like, you got to get out and this, has to get in because they need it. And so it has a certain value. And to some extent, that's true even if we talk about banks or something, right? So let's say you took a bank and they end up with poor management eventually on the lending side and stuff. That's really bad. They could ruin things and whatever. But if they have this amazing deposit base from the previous generations of who was running it and stuff, then actually that has a lot of value because it could be sold to another bank, basically. And so that has an enduring value that way, that you have that kind of defense in depth that we're talking about, which is a very Ben Graham concept. He liked something where there was both some earnings protection and asset protection. And that's the thing I think people overlook. What he talked about was like buy a low PE stock, but buy a low PE stock that's also a net. Don't buy a net that's never earned any money or anything. And don't just buy a low PE stock that has a really high price to book value, right? Because people talk to me about those kind of things all the time, where at this moment, because there's like a shortage of something in their industry or whatever, they're suddenly earning a 40% return on equity. But you have to understand that I don't know if it's a value stock if you're paying like a 6 times earnings, but you're paying 4 times book.
Sure.
It might be. And vice versa, if you're paying half of book, but you're actually paying 15 times the best earnings it's ever had in its history, I don't know if that's a value stock. That might be slightly a value stock, but it's unclear. It's
kind of like the whole buy on the balance sheet and sell on the income statement.
Right, exactly. And you can have a lot more confidence with that if you know that other things in the industry that are the same assets are productive. Okay. Right? So if you know that the average car dealership earns a 10% return on equity, then if you're buying at half of price to book, then you're in a pretty good position. Or it could be banks, or it could be insurers or whatever. If you're paying a small fraction of what others would earn on that, then in different hands, you could have defenses that way.
What are some other things? So we talked about price a lot.
Yeah.
And then on the business side of things, you talked about, maybe the ability to leverage up, staying solvent, capital, the company's general thoughts to capital allocation so they're not going to dilute me. What are some other things that only add to the margin of safety?
Okay. The number one would be, how successful is a really bad business in the industry? The best industry is one in which I think they're kind of run a little incompetently and whatever, and they're still earning their cost of capital, basically.
Business so wonderful, any idiot can run it.
Right. Yeah. So is the 4th or 5th player in the industry who's made a lot of mistakes and stuff still earning their cost of capital, or are they like managing to lose money every year and stuff, And so in some of these, they're not terrible that I mentioned before and stuff. So actually there aren't that many owners of the actual asset. They could own other things, but of like actual cement plants or actual, or actual car dealerships or whatever that are managing to lose a lot of money. They can at some points lose some money and stuff, but usually not. I mean, railroads and supermarkets and stuff historically are a good example. They go bankrupt because you put too much debt on them and stuff. Usually they don't actually manage to run them so badly that they actually lose money on an operating basis. Or like we talked about cruise ships, and cruise lines. So why can they borrow money and stuff now? To some extent, it's because if I look back at the last 10 or 20 years, for the major cruise lines that exist, I don't see where they lost money on like an EBIT type basis, right? So that is just a lot safer to borrow money than something else. And same thing, like I said, like a supermarket or something. So COVID, supermarkets are doing better from it, not worse. Yeah. But if something had happened that suddenly people couldn't buy food for a few months or something, bankers and people who buy bonds and stuff would still be willing to lend to supermarkets because they have a very long history of not losing money before interest payments, right? So if you have an industry like that where almost everyone who's been in the industry a long time has one of the leading positions, is able to stay solvent throughout a cycle and stuff, then that's a pretty good situation. I mean, there's like, we talk about advertising things and stuff, and people ask which one's the best one and stuff. The truth is the worst advertising agency is in less of a likely position to lose a lot of money than the best company in some industries. Now, they may not be able to grow and stuff that much, but they're really unlikely to actually lose a lot of money and to end up like, not being able to pay their debts and stuff. What if the business doesn't have a ton of competitors? Like, what if it's like a Facebook or a Amazon, for example, or, or let's say like a Zoo Plus? Sure. Those are the complicated ones because they go against the defense in depth concept. In a sense, it's all or nothing. So it's a strong point defense thing. If you're completely convinced there's no way that they'll ever lose their position, that's
like,
great.
what if they own the whole market, essentially?
Right. But if anything ever happens that they don't own the whole market, you'll lose a ton of money in the stock. So if anything ever happens that, take Google or something. If anything happens at some point where YouTube has 50-50 market share with someone else, or the Google search engine's 50-50 market share with someone else, that's a great position. You own half the world. The stock will have performed terribly for you because it'll be a disaster. Just because in terms of the multiple that you paid and also because of the huge decline in what you had. And so that does happen in some things. And you can be wrong in that. I mean, you can think that, Kodak or whatever will always have great market share and things, and then eventually it doesn't.
Yeah.
But I think generally those are the two opposite sides of things. Those are the ones in which you have to be either completely convinced, the wide moat type things, and then there's the other ones which are how will this business be if it's a little worse competitive position, if it's a little worse. I mean, when I talk about the defense in depth thing, the things I think about are margin of safety in the stock price, right? Good industry, good company.
So let's go down, right? Margin of safety, so two-thirds
or less of like an average type price. So I would say like that's why you want to pay 10 times for an industry you're sure is worth more than 15 times, that kind of thing. Yeah.
We talk about the industry. So what's the competitive position? It has been a 100 bagger.
It's better than most industries. Better than most industries. Management, right?
Yep.
Is management better than most? And then if you have those four things, there's also the company's position in the industry. Then in a sense, you could lose some of them and you still work out okay for you, right? So if it's a better retailer than most, okay, can you still do okay in the stock if it becomes simply an average retailer? I like the idea of buying into a company with great management, but honestly, when I look at them, I say, am I still paying a low enough price if tomorrow they're replaced by a mediocre management? Because then it becomes more defense for me that I have a great management.
Yeah.
But I don't ever want to buy a stock on the assumption that I have to keep this great management in there, because then you don't really have much of a margin of safety. You're actually counting the management twice in a sense, So same thing with the industry. Although I like one thing that's a little tricky. So I'll give an example here, like Costco, right? So Costco is a great retailer, great business. But one thing that's scary about it is if you ever pay the prices that stock is traded at, if it becomes simply a above average retailer, you'll lose a tremendous amount of money.
Because you paid a high enough price.
Right, because you paid such a high price versus what competitors are trading at. So that's what I consider not defense in depth. That's strong point, where it is, I'm completely convinced that the culture and stuff at Costco is going to stay the same forever. And, and the same thing could happen with banks. It could happen with insurers. When I would write up like Progressive or something, you have to understand that when you do that, or Frost is a bank or something, when you do that, you are relying on the situation will never get as bad so that they're totally mediocre. Because the price that Progressive stock is traded at has always been too high versus an average auto insurer. It's been at the level of what you should only pay for like a Geico or a USAA or something like that, not for your average one. And the same thing with banks. With Frost and stuff, when I wrote that stock up, basically I was saying it can't get into a position as bad as your average bank is. If it's just an average bank, then of course you have to pay an average price to book.
Cool. I want to thank everybody so much for tuning in with Geoff and myself on the Focus Compounding Podcast. We hope everyone enjoyed the episode. If this is the first time you're tuning in, make sure you hit those subscribe buttons. Pumping out 5 episodes a week, having a lot of fun doing it, and we're definitely super thankful for all the support. I want to thank everybody so much for tuning in, and we will see you in the next podcast.